Money market yields have hit a 16-year high and have become an extremely attractive proposition for investors in 2024. Because depending on your risk appetite and market conditions more generally, you may have anywhere between 2 and 10% of your portfolio held in cash or cash equivalents. But the mistake that investors make is that the value of your cash is eroded over time with inflation. And coming off the back of a year with high inflation, it's super important to make sure the cash you have is parked in the right place whilst you wait around to make your next investment, which is where money market funds offered by brokers like Trading 212 can be a great way not just to protect, but also grow the value of your cash over time too. Now, money market funds are one of the hottest investments in 2023, with a record $1.19 trillion of inflows into the US money market since the 1st of Jan. But will they be just as hot in 2024? Well, with it being one of the best ways to invest your cash in the short term in a low risk, but also a high yielding investment, I certainly think it will continue to be an important part of an investor's portfolio, especially while central bank rates remain high. So today I'm going to explain everything that you need to know about money market funds before you dive into investing in one. But before I do that, I just want to say thank you to Trading 212 for sponsoring today's video. So let's kick things off by talking about exactly what a money market is. In the world of investing, you've more than likely come across the term financial markets before. It's an organized forum where different financial instruments are traded, like what you see on the trading floors on Wall Street. Now, within financial markets, you have two different types of markets. First up, you've got capital markets, which handle both stocks and bonds. It's where you can buy your shares in Apple, Amazon, and Tesla with the aim of getting a return on those investments in the stock market. Or you can invest in longer-term government and corporate bonds on the bond market through your brokerage provider instead. Now, separate to capital markets, you have the money market, which is a highly liquid market aimed at providing stability in the value of investments in the short term. Now, when I say short term, I typically mean investments that have a maturity date of less than a year. Some examples include bank certificates of deposits, corporate and sovereign bonds, UK government bills, and cash deposits. Essentially, it's just another mechanism for governments, corporations, and large financial institutions to raise capital in a liquid marketplace. And the benefit for all of you cash hoarders out there right now is that because of rising interest rates, the yields on the money market have actually risen too, therefore making it attractive to investors.
That's cool.
Especially the investor that's perhaps sat a little bit more cautious in today's market after seeing the S&P 500 rise the best part of 24% in the past year, and with now slightly higher PE multiples, is perfect for the investor who wants to hold a little bit more of their portfolio in cash.
Look at all that cash.
But how exactly do you get your cash working for you and actually buy into the money market and get yields upwards of 5%? Well, to do that, you need to invest into something called a money market fund. You may have heard of index funds or perhaps exchange-traded funds in the world of the stock market. Well, a money market fund kind of works in the same way. It's a product offered by a broker made up of a collection of financial instruments that's managed by a fund manager that provides you with a rate of return. So in the example of an S&P 500 exchange-traded fund, that fund is made up of the top 500 companies in the United States of America. But with a money market fund, you have a collection of short-term money market instruments instead. Typically in the UK, these are made up of government bonds or gilts, which are probably one of the safest as they have the backing of the UK government, along with commercial paper issued by financial institutions, which is to get short-term funding by high credit quality companies. And finally, certificates of deposits or CDs, which are deposits with banks that pay a fixed rate of interest. Now, to give you an example of what a fund like this could look like, here is the Sterling short-term money market fund over on Vanguard UK with the ticker symbol VASSTAI. In this specific fund, we have 55.5% in UK Treasury bills, 21.7% in UK commercial paper, and 20.5% in time deposits, or what I previously referred to as CDs. Now, as I've kind of touched upon already, all of these investments are high credit quality, meaning that the value of your money should technically be safe.
Don't misplay it safe.
Obviously, with any investment, I've got to say your capital is at risk, and you must always do your research prior to investing into any financial instrument. But rest assured that money market funds are certainly on the lower risk end of the risk spectrum, which I guess is why they're so appealing right now. They're low risk, but their yields have risen massively in the past 12 months. It kind of highlights the importance of being a little bit more flexible with your investment approach and your investment strategy too. Whilst yields are high at say around 5%, it probably kind of makes sense to have a small portion of your overall investment portfolio held in these kind of money market funds or cash equivalents. Whereas when money market fund yields start to decline to have perhaps 1% or 2%, then you might want to then consider perhaps reinvesting that money back into the stock market to get a higher rate of return.
Show me the money.
But when investing into a money market fund, the way the money or the yield is paid to you is via interest payments. And just to be clear, the yield that you get is not through the capital appreciation of the fund like you would kind of expect to see from the normal growth in a stock price. Instead, the fund's value is actually designed to stay at the value of £1 to ensure the market remains liquid at all times. The interest payment therefore then generated is paid into your uninvested cash within your brokerage account, which for this specific fund that we're talking about is paid on a monthly basis. Not a bad way, I guess, to earn a little bit of passive income on your cash within your investment portfolio. Now, it also must be said that these investments are designed to be short-term investments. They're not really designed to be held for 5, 10, 15 or 20 years. Instead, they're designed to say if you were to sell £5,000 worth of stock tomorrow, you would have that money held in uninvested cash within your investment portfolio. And let's say at this point in time, you weren't ready to reinvest that £5,000 straight away into another equity or whatever the investment is that you were making. And instead, whilst you waited for that opportunity to arise within the market, you could put that money into a money market fund in order to ensure that you still got a rate of return on that money. And the reason why you do that is, as I said at the start of the video, it's to ensure that the money that you have held in cash isn't eroded by inflation. On, say, a 4.5% yield over a 3-month duration, that's an extra £56 to invest, which is the equivalent to 18 shares worth of Rolls-Royce, which when you put it like that certainly makes you realise that it's worth the effort moving that cash into a money market fund to optimize the rate of returns that you can get from your investment portfolio.
Nice.
Now, Trading212 have made accessing money markets super easy on their platform in a rather unique offering that differs from other providers out there. You don't need to go searching through a long list of funds, which can be confusing and time consuming. So instead, let me show you how to do it on the Trading212 app with just a couple of clicks. And all you need to do is come onto the bottom 3 dashes on your Trading212 home screen, and then you need to go on where it says earn interest on cash, and then there should be an option which says unlock higher interest, which you'll then be able to tap in order to enable the feature. This will then boost your interest rate on uninvested cash from 2.15%, which is what I get currently, to 4.5% if you held sterling within your investment account. If you're holding US dollars, it will boost to 5%, and if you're holding euros, it will boost to 4%. The cash is paid into your account daily, which you can then either withdraw and put back into your own bank account, or you can then reinvest it into capital markets when the right opportunities present themselves. You can change your mind at any time and opt out of the interest sharing program over on the Trading212 website. It just means that your money won't be invested in a qualifying money market fund, and therefore you won't receive any interest on your uninvested cash within your Trading212 portfolio. Also, it's important for me to say that if you don't make a selection by the 12th of February, then you won't receive any interest on your uninvested cash on Trading212 moving forwards. Kind of a case of use it and take advantage of it or lose it. Now, if you don't already have an account with Trading212, then be sure to click on the link down in the description below, whereby when you sign up, you'll get 1 free share valued up to £100 in order to get your portfolio off to a strong start in 2024. Now, there is one more very important point that I wanted to touch upon around money market funds, and that's the risks associated with them. Because when investing, you should always be aware of the risks associated with said investment, even if the risks are perceived to be minuscule. Now, as I said earlier, money market funds were hot last year. In the US, money market assets rose to $5.8 trillion, which was a record at the end of 2023. And that's because the federal fund rate looked like this, growing to over 5%. The reason being, money market fund yields are correlated to what the central bank rates are. Now, over here in the UK, we have something called SONIA, which is the Sterling Overnight Index Average, which as of right now sits at a spot rate of 5.19%, which that minus some fees is what you can expect to receive from investing into a money market fund here in the UK. And here comes the risks with that. It's great while central bank rates have increased to over 5%. But if central bank rates go down, then the yields on your money market fund will also go down too. And in actual fact, some economists and investors are predicting that central bank rates could come down at some point during 2024. Especially with inflation now coming back under control, we could start seeing an easing of those central bank rates later this year. So just be mindful that just like capital markets, money markets also change too, and that you should have a proportionate asset allocation based on your own risk appetite and your own investment objectives at all times. And if you're one of those individuals that's just simply looking for a low risk, stable investment, then the bond market may be just as, if not potentially more favorable than short-term money market funds. Essentially, the game here is to always make sure you're being efficient in optimizing the returns on your investment portfolio. And if you've got £1,000, £5,000 or £10,000 held in cash uninvested on trading 2-on-2, then it might be wise to enable the feature in order to get a little bit of return on that money before you invest it into the capital markets. Still means you get a bit of upside on your money, but just in a low risk way without it being completely eroded by inflation. Now, I've personally set out the goal for 2024 to grow my personal investment portfolio by over 5 figures this year, but if you want to know how I managed to do it last year, then be sure to click on that video next. But before you go, be sure to subscribe to the channel if you want to grow your wealth in 2024. And on your way out, be sure to drop a like on the video as well, guys. It really helps out the channel. And with that being said, I'll see you over in the next one.